great to see so many people joining, and then listening the interesting topic of fundraising and different forms of fundraising as well. And we wanted to share basically our long experience and long knowledge about different types of fundraising, because there's not only one type of fundraising. There's several possible ways of funding a great business and growing a great business as well. And then we'll be looking at 4 different options today. So we'll be looking at bootstrapping, public funding, venture capital, and venture debt separately. And basically, I'll be covering the first 3 topics, and then John will cover the venture debt topic. And basically, just as a summary or an introduction to everybody. So bootstrapping means that you're financing your operations and your growth by cash flows that mostly come from your customers. Public funding is a great companion for bootstrapping, meaning that you get grants and loans from the government wherever your company is based. Venture capital means that you're selling part of your business, you're selling equity, and you're getting money from investors. And then venture debt means that you get debt you get a loan for your business, and these can be combined. You just don't have to choose one. You can choose one or several of these. Even you can choose all of them. For example, at Calqulate, we started as a bootstrap company. We got public funding, we got venture capital. We'll probably try out venture debt as well. So then we're probably a good example of kind of multi-financing company. And then if we kind of split these 4 different topics into dilutive forms of capital and non-dilutive forms of capital. Like non-dilutive means that you're not giving any ownership of your company, you're not selling equity. And bootstrapping, public funding, and venture debt by default in their basic forms means that it's non-dilutive capital for you as a founder. And venture capital means that it's dilutive. It dilutes your ownership as a founder. So it's good to remember these two words, non-dilutive and dilutive, and we'll be covering all of those today. So let's start with fundraising in general. Like when you're fundraising, no matter what you're doing, you're going to hear no quite a lot. So just deal with rejection. Somebody is always going to say no to you, and often fundraising is not a fun business in a way. So it's good to have a lot of different forms of funding to your company, so that you can build a great cap table. You get maximum financing with minimum dilution. That's also a concept that we could talk about today a little bit more, so that if you decide to sell your company, in the end you get the maximum benefit to yourself as a founder as well. But basically I think our team has written this here, like coffee in one hand and confidence in the other. Like just deal with rejection and be confident and build and grow a great company. That's it. So let's start with bootstrapping. This is the this is what every single company should be doing, no matter what. No matter if they take venture debt, no matter if they take VC funding, they should get money from their customers, and they should basically invest money that they get from their customers to growth. But bootstrapping means that your sole way of funding is money from your customers. So this means that you probably need to have a little bit of personal savings or a lot of time and secure income. Otherwise, when you're building or starting with a bootstrap company, and then often it's good to start with a simple problem that you're solving, that you can actually develop a product really quickly, like in 3 months or 6 months, and then you start getting money from your customers really quickly, and then you can hire more people and then speed up development and speed up customer acquisition. So this is how most companies actually start. Like 80% of startups begin this way, and then they might evolve into some other forms of funding, or they just build a really good business with just being bootstrapped as well. But in the beginning, you probably will be super tight, super stingy, and you're not spending a lot of money on anything external, basically. Let's go and see the pros and cons of being a bootstrap company here. So some of the pros are that you as a founder retain total control of your company. You're not selling equity. You don't have to take external board of directors in your company, and if you decide to sell your company, you get the maximum benefit, and then you don't get any pressure from investors. So these are some of the pros that one has to think about when you're running your own business. But the cons are also that in the beginning, especially, you probably don't have a lot of resources. So then if your competitors have raised funding, you might be a lot slower than them. And then because you don't have that many resources, that might cause some stress, and it might cause some lower credibility from external parties, etc. So there's some cons that basically have to be considered as well. But a lot of great companies have been built, being bootstrapped for the first years or the whole operations. So this is a really good option for a lot of companies. So start simple and grow your business incrementally as well. So let's look at a couple of companies in the next slide that have been they started being bootstrapped. They might still be bootstrapped, but then basically these are great examples of bootstrap companies in the beginning. And let's move on to the next topic, which is public funding here, especially if you're based in Europe, or if one of your group company subsidiaries is based in Europe, you most likely will get some public funding if you know where to look for it. Especially in Northern Europe, there's a lot of possibilities. European Union has a lot of possibilities for public funding, and basically you need to have a scalable international business idea, or you're building a business for a good cause, like green business, sustainability, etc. You'll most likely get public funding, and then basically often you get funding already at the prototype level. Like we got our first, Calqulate got the first public funding from the Finnish government. Even basically we had like a one design screen or something like that, and we were able to hire a couple of people with that money. So look for public funding really early on. They usually come in the forms of grants and loans that add them your bootstrapped cash flow forecast, and then you'll be able to evolve and develop your business much faster as well. But there's some pros and cons with being bootstrapped as well. So let's look at that. Sometimes it's a really difficult to find out where to get that money, and then it's a bit conservative, or let's say it might feel slow and really conservative when you're talking to these government agencies. But the pros are that you get more resources, you get more money, you're not diluting your ownership, and you might even get some opening doors from the government agencies, etc. And then they might introduce you to a lot of people, and you get free advisors, etc. But public funding means that there's usually a chain of public funding. There might be like 5 instruments that you might be eligible for in the next 3 years. And when you're applying for the first one and you're writing your application, you kind of need to know what is the second step and what is the third step, etc. They usually come in different instruments. And then there's some restrictions. There's a lot of target setting as well. And then when you start the first application, there's targets to reach for the first one, and then the second one starts, and then there's targets to reach, and third one, and fourth, and so on. So then you need to build a clear story and clear targets, and you better reach them as well. If you don't reach them, you might not get to the third level, etc. And there might be a lot of restrictions as well for ownership, etc., for your company structure, etc. So be sure to basically do some due diligence on the public funding. But generally speaking, a really great way to build a good company here. let's look at the next slide here. So there's some companies here that have gotten public funding here. Calqulate could be also, one of these companies. We've gotten quite a big amounts from the Finnish government, and most likely get some money from the European Union as well. We are also eligible to get money from the French government because we have a French subsidiary over there. So just look for public funding. You most likely get it if you have a tech company. Let's talk about venture capital shortly before John starts talking about venture debt, because often venture capital and venture debt can also be paired, and this can be paired with any forms of funding as well. The basic thing about venture capital is that you're raising money from institutional investors, VC funds, maybe family offices, etc. And it's the fastest way to grow a company. It's if you want to build a product that wins the race and conquers the market, you most likely need to raise a lot of money for that to build a great product and to sell efficiently as well. But it means that you're always selling your equity. You're selling most likely 10 to 20% of your company per each funding round. 10 to 20% is a lot of equity. And imagine if you have a pre-seed round, seed round, Series A, Series B, and so on. In the end, you might not have a lot of equity as a founder, and then you might not benefit in the end that much. Your investors are going to benefit because of the different clauses in the investment agreement, but you as a founder might not benefit that much. It's good to keep that in mind. And when you're fundraising, when you're raising venture capital, you need to know exactly like how much you're worth at each stage, and then how much you want or need to raise. So you need to build a realistic financial forecasts and staff planning, customer acquisition cost, KPIs, etc. So how long are you planning your cash runway, and then how much you need right now to get to the next level as well. So know exactly how much you need, how will you spend it, and what your investors can expect as return here. And then basically you start the fundraising, venture capital fundraising at very early on if you go to that path often, at seed stage or Series A, and often it means that you're continuing on that path as well. Your investors want growth, they want profit, they want an exit. So you're not going to own your company forever if you take venture capital here. Let's go to the pros and cons of venture capital here. So it's also pretty clear and obvious. If you can raise a lot of capital in the beginning, it means that you can hire a bigger team. You can spend more money on customer acquisition. You might have a lower personal financial risk as a founder as well. Then it's a little bit easier to network with other successful entrepreneurs, etc. And you don't have to pay a debt back. You don't have to pay back your equity basically, and it's the company can spend it. That's a good side of it as well. So it's kind of like you have locked in the cash flow, and then you just spend it and grow your company. Some cons as well. Each funding round, you're giving up control. You're selling your equity of your company, and when you're fundraising, it's a long process. I know it as a CEO. Like when we are fundraising, I'm doing that full time, and then I'm supposed to do something else after that. So then when you're actively fundraising, like every 18 months or every 24 months, you can expect to spend at least a third of that time fundraising, even more, quite simply. And then it's a long process, and you could use that time better with building a great company, building a great product, and selling and getting customers, and then financing your company with the cash flows that you get from your customers as well. And it's really expensive capital. So equity capital is really expensive and you're going to spend a lot of time in preparing for due diligence in the funding round and doing due diligence. It's a really intense process. So I can ensure that I've gone through several of them and then spent a lot of time in fundraising as well. And if you're fundraising, you'll be doing that as well. And I think that was pretty much my part for the venture capital. I think the next slide, we have a few examples of successful companies who have raised venture capital. For example, like Stripe is a great example. They value now, I think, at $100 billion. They raised a lot of money here, and then they've managed to, with those cash injections, to build a great product, a great company, and then expand into different markets. So that those are some of the successful examples here. And now I think it's time to give the floor to John.
Thank you very much for having Element here with you guys today, and allowing us to talk a little bit about debt and equity and maybe some of the differences of pitching to debt investors and pitching to equity investors and some of the nuances. And I think one thing I found over my career is that sometimes companies and founders sometimes forget to look and understand the person and the fund with who they're pitching to, and getting to the nub of that is really important. I think when you're pitching for your business and raising money, whatever kind of money that is. So we're talking today about venture debt, and Nick, you've given a great overview of the landscape of everything from the more benign sources of funding and grant aided and public funding, and also equity funding. But understanding what debt funding is and how to build up a really good mix of funding over time is really important. So understanding the fundamental differences between debt and equity is really, really important. And understanding that what you pitch to a debt investor or a bank or anybody that's providing debt is fundamentally different to how you would pitch an equity investor. And I think sometimes it's really good to actually understand and getting in through and looking at things through the lens of the investor. And if you think about it from venture capital perspective, one way to really think about it and understand venture capital is it's a hits business, so it's high risk, high return, and for every euro of a check that a venture capital fund will write, they will be seeking to get up to 10 times a return on that investment to cover all of the other bets within the fund. So it's really important to understand the economics of the funder and the person, the fund who you're pitching to. Debt then is the complete corollary almost of that, and it's lower risk and a lower return. So yes, some risk, but it's a lower return. And I always love the analogy when I'm talking about debt and equity and how to pitch for saying to CFOs and CEOs is to think of it very simply like a horse race, And if you think of it like a horse race, the equity investor wants you to win the race. They want you to become a global category leader, a winner. They want you to be placed in the race, and have a knockout performance. However, a debt investor really just wants you to finish the race. They want to get their money back, with a coupon on that. And they're really not interested in the massive burn. They're interested in growth, obviously, but not interested in the massive burn. And you do need to think about who you're pitching to in the context of those two distinct forms of capital, debt and equity. And again, if you think about yourself as kind of the master of your own destiny, you're trying to take on those non-dilutive sources of capital, as Nico said in the early days. But you're also you should have a longer term aim, which is to try and get an overall mix of debt, equity, founders capital, angel capital onto your balance sheet. So over time, the overall average cost of capital is reasonable and normal. And we will all have heard stories over years of the massive big exit that's been seen on TechCrunch or whatever it is, but actually very little would have been paid to perhaps some of the personal wealth that perhaps the founding team would have created along the journey. And if you're consistently selling equity or raising a very expensive equity, you could end up with a very small portion, which is really disappointing and sad to see, because it does happen quite a lot. And again, your aim is to raise the right mix and put the right ingredients together over a period of time as you grow the business. Just maybe to look at some of the pros and cons of venture debt on the next slide. So the obvious pros, again, are here. We've mentioned this concept of dilution, right? So selling equity requires giving up some of your own percentage ownership of the business. It can mean giving up quite a degree of control in the business too, depending on the situation. So overall, you want to get the right blend, take on debt at the right time in the right proportion so that it doesn't smother the business, but also is managing the loss of ownership as you go along. I think the other thing, just in the context of that, you've got two things to think about, and you've got the business's own balance sheet and putting the right amount of equity and debt on the balance sheet, but you've also got a personal balance sheet. You've invested time and effort and blood, sweat, and tears in building a product and a company and a culture and a brand. You want to make sure that all of the hard work is worth it at the end too. So you need to think about your own personal balance sheet, what equity ownership you hold. So the pros of debt is obviously used appropriately. It minimizes dilution and longer term wealth creation. Most debt providers don't take any active participation in the board or the direction or the strategic direction of the company, and so no interference, generally speaking. The cons are the cons like we would look at if we were taking out a mortgage to buy a house. Debt needs to be used appropriately. Debt or leverage, as it's almost sometimes used as well, is that it is leverage. It gives you the power to achieve more, but not losing control. So using it in the right method and with the right dosage can be very powerful. But also as well, if things don't go right, you do give collateral to your debt holder in the form of the IP to the business, typically with no personal guarantees or anything like that. But ultimately, the lender does have collateral or a fallback position of the IP in the business for whatever that may be worth. That's the lender's kind of a judgment call in determining the risk. So debt does require collateral, and it's important to know that. Some lenders, and there's been quite Europe is probably behind in terms of the provision of venture debt overall within the tech ecosystem compared to the US. Approximately 5% of every venture capital deal in Europe would have some form of venture debt alongside it. Whereas in the US, that would be 4 times that, at least 20%, particularly in this market where Nico has outlined as well. There's quite a lot of money, quite a lot of dry powder, as they say, a lot of fresh capital to be deployed across venture capital and private equity. And there's a commensurate amount of debt capital to boot as well. So the venture debt market is quite good, and it's becoming more available. But you do need to be very wary in picking your partner, just like you pick your partner in your co-founding team, or picking people to join the journey, and picking a venture capital partner or a sector specialist for the cup. You do need to look at your debt partner quite closely too, because we've seen over the years all sorts of nasty terms and conditions in there that you really need to have an advisor or somebody who's looking at the detail quite simply and making sure that there's no nasty things in there to trip you up. But again, back to it. Overall, the overarching objective is to build the right blend of equity and debt in your business over time, and to kind of average out a blended cost of capital that is reasonable, that makes sense, preserves wealth, and is the right thing for the business and for you and your team.